Hello there, welcome to Finance Teacher. This is the first in a series of 4 videos that explain a structured product called Dual Currency Deposit, DCD, also known as Dual Currency Investments. We'll use the terms DCD and DCI interchangeably throughout this video series. In this video, we will discuss the basics of DCDs, take a couple of examples to explain how they work, the position of the strike price, and key features, benefits, and risks of DCDs. So let's get going. Now, what is a dual currency investment? Suppose you have US dollars 100,000 for investment and you are given only two choices on where to invest. Choice 1, you can put the money in a fixed deposit with a bank that pays 9% interest per annum. Let's say that the period of deposit is 1 month. At the end of the month, that is upon maturity, you will get US dollar 100,000 into 1 plus 9% into 30 by 360, which is equal to US dollar 1,00750. Note that you are sure to get your principal plus interest in US dollars. The bank cannot choose to repay you in some other currency. Also, the maturity amount is absolutely certain. Basically, you are almost certain to get the USD 750 interest for the month and get your principal back. The only situation where this is not going to happen is if the bank goes bust, and that is a very rare situation, and most probably the government will bail out the bank or some deposit insurance scheme will save you. So you have a lot of certainty and backup when you make a fixed deposit. Let's look at the second choice that you have. You can invest the $100,000 in a structured product called the dual currency deposit or the dual currency investment. Let's say that the DCD is issued by a bank. However, your deposit will not be covered under the deposit insurance scheme. So it is not really a traditional deposit. Let's see why. Say the DCD pays 12% interest per annum, which is much higher than the 9% in the traditional deposit. So what is the catch? Obviously, higher returns come with higher risk. Upon maturity, the bank reserves the right to repay the principal plus the interest in some other currency called the alternate currency instead of the investment currency USD. That is, upon maturity, you may get your return, the principal and the interest in US dollars or in a pre-agreed currency called the alternate currency. The alternate currency and the rate at which the USD principal plus interest will be converted to the alternate currency will be decided at the time of making the deposit. You can choose the investment currency and the alternate currency. Each DCD issuer will give you some choice. Let's say that you choose Singapore dollars SGD as the alternate currency and the current spot price of USD SGD is 1.45 and the conversion rate is fixed at USD 1.48. This means that the bank may repay the principal plus the interest in Singapore dollars if it chooses to do so. Note that the bank has the sole discretion to choose the currency of repayment irrespective of the spot rate on maturity. However, if it chooses to pay in the alternate currency, the conversion from the US dollar to the Singapore dollars must be done at 1.48 irrespective of the spot rate on maturity. Normally, and for good financial reasons, the bank will convert if the US dollars SGD spot rate on the reference date, say on the 30th day, is above 1.48. If this does not happen, that is the USD SGD on the reference date is 1.48 or below, the bank will pay the principal and the interest in the original investment currency of USD. This is simply because it makes financial sense for the bank to do so. In effect, the bank will always pay in the currency that is weaker with respect to the conversion rate of 1.48. If the spot rate on maturity is 1.46, it means that USD is the weaker currency with respect to USD SGD 1.48 and the payment will be made in USD. If the spot rate on maturity is 1.5, it means that the SGD has weakened if one looks at it from the perspective of the conversion rate, and therefore the payment will be made in Singapore dollars. Therefore, in all scenarios, the bank has only two choices on maturity. The bank has the choice to either pay $100,000 into 12% into 30 by 360, which is equal to US dollars 101,000, or the bank can choose to pay Singapore dollar 101,000 into 1.48, which is equal to Singapore dollars 149,480. So you need to remember these two amounts, US dollars 101,000 or Singapore dollars 149,480. Note that the bank invests the money received from the investor in US dollars. Deposit somewhere where it expects to get more than 1% return for the month so that it can make a profit in the deal. Let's look at scenario 1 for this dual currency deposit. Suppose the spot rate at maturity is 1.46. Now, the bank will pay US dollar 101,000. There will be no conversion because the conversion will not make sense to the bank. Note that the bank has the discretion to still pay the equivalent of USD 101,000 in SGD at the conversion rate of 1.48, which is basically 149,480, but it will not choose to do so in such a scenario. Suppose the bank makes a mistake and it converts the US dollar 101,000 to Singapore dollar 1.48 and pays you Singapore dollars 149,480. Now, in order to pay Singapore dollars 149,480 to you, the bank will have to buy Singapore dollar 149,480 and it will have to sell US dollars in the market at 1.46, the prevailing spot rate on maturity. So, the bank will have to spend US dollar 149,480 divided by 1.46, which is equal to US dollar 102,384. In effect, instead of simply spending 101,000 to close the contract, it will be spending US dollar 102,384. And if you sell the Singapore dollar 149,480 received from the bank in the market immediately at 1.46, which is the spot rate, you will get US dollar 149,480 divided by 1.46, which is 102,384 US dollars. This will mean that the bank has paid you 2.384% interest for 1 month. And that will be pretty irrational for the bank because the bank promised you 1.1% for the month. No bank will pay beyond this 1% or the promised return. Basically, the bank will never pay you more than it promised. Therefore, it will not convert unless the spot rate moves above 1.48 on maturity. Else, it will be paying more than it promised because it will need to buy Singapore dollars at a higher rate in the market than the conversion rate. Remember, the SGD has strengthened and the USD has weakened in this scenario. The bank always pays in the weakening currency when you look at it from the perspective of the strike price or the conversion rate. The bank has calculated its maximum cost at 1% per month. The bank is taking the risk of paying higher interest because it hopes to make money in the product. And the bank invests the money received from the investor and the excess return is the profit. The margins are likely to be thin and such mistakes are unlikely. Now let's look at scenario 2 of this product. Suppose the spot rate on maturity is 1.5, which is above the conversion rate of 1.48. That is, the Singapore dollar has weakened with respect to the US dollar and has moved above the conversion rate. The bank will need to spend less USD to buy the equivalent Singapore dollars because the existing spot rate is more than the conversion rate. Therefore, the bank will pay you the maturity amount in Singapore dollars. It makes financial sense to do so. You can understand it like this. First, the bank will calculate the maturity amount in the investment currency, that is the US dollars, as follows. Principal plus interest is equal to US dollar 100,000 into 1 plus 12% into 30 by 360, which is equal to US dollar 101,000. Now, this amount will be converted to Singapore dollars at 1.48, the agreed conversion rate. Therefore, you will get Singapore dollars 149,480. However, the bank needs to spend only US dollar 149,480 divided by 1.5, which is equal to US dollar 99,653 to buy the Singapore dollar 149,480. Looked another way, if the bank pays you Singapore dollar 149,480 and you sell the Singapore dollar 149,480 in the market immediately at 1.5, the spot rate, you will get US dollars 99,653. Hence, you will lose money instead of making money. Your loss is the bank's gain, presuming that the bank invested the US dollar 100,000 received from you instead of converting the USD into Singapore dollars and investing the Singapore dollars at the outset. Presuming that the bank gets 101,000 from its investment, it will make a profit of US dollars 1347 or 1.35% approximately. In percentage terms, you will get a negative return, a loss of minus 0.35%. Note that while you get 1% return in USD terms, the Singapore dollar has weakened by 1.5 minus 1.48 divided by 1.48, which is equal to 1.35%. Therefore, on a net basis, you lose 0.35%. Note that since the promised return on investment in US dollars is 1%, the investor or you will not lose a part of the principal if the depreciation in the Singapore dollars is roughly up to 1%. Beyond 1%, you will start to lose money. You will get less than what you invested. And note that these numbers are not accurate, as we will discuss later in detail. Let's quickly discuss another DCD with the currency pair GBP Euro, where Euro is the investment currency. Basically, the investment currency is also referred to as the placement currency or the base currency or the original currency in a dual currency deposit. And GBP is the alternate currency. The investment amount is Euro 100,000. That's why Euro is the investment currency. And the yield is 12% per annum. The conversion rate or the strike price is GBP Euro 1.12. The initial spot rate is GBP Euro 1.16. And the maturity is in 30 days. Note that this time the conversion price is below the spot because Euro is the investment currency and Euro is basically the second currency in the quote. On maturity, the bank will repay in Euro if the spot GBP Euro is greater than or equal to 1.12. The payment is going to be Euro 100,000 into 1 plus 12% into 30 by 360, which is equal to Euro 101,000. For example, if the GBP Euro spot is 1.14, the bank will pay the investor Euro 101,000. The investor will earn Euro 101,000 minus Euro 100,000 which he invested is equal to Euro 1,000. If the GBP Euro is less than 1.12 on the maturity date, the bank will repay in GBP. And the amount which the bank will repay will be GBP 101,000, which is the equivalent Euro amount, divided by 1.12, which is GBP 90179. For example, if the GBP Euro spot on the fixing date or the maturity date is 1.10, the bank will pay the investor GBP 90179. The investor will be able to sell this GBP 90179 for Euro 90179 into 1.10, which is actually the spot rate at that point, to get Euro 99197. Therefore, the investor's net in Euro terms will be Euro 99197 minus Euro 100,000, which is a loss of 803 euros. Note that the strike price can be fixed above or below the spot rate depending upon certain conditions. In this context, let's understand how the conversion rate is positioned while creating a dual currency deposit. Note that the investor expects the investment currency to depreciate so that he receives the maturity amount in the investment currency. Therefore, the strike price is always set based on a few percentage points depreciation on the alternate currency. Basically, the weakening of the alternate currency beyond the conversion rate is bad for the investor and it is good for the bank. This weakening can happen if the exchange rate moves up or moves down depending upon which currency in the currency pair quotation is the investment currency. As we know, a forex quote has a base currency, which is the first listed currency, and a counter currency, the second currency. However, we will use the terms first and the second currency in our discussion. This is because the term base currency is often used in DCDs to denote the investment currency or the placement currency, also known as the original currency. Let's take the case of GBP USD. The quote is GBP USD spot is 1.50. Here GBP is the first currency and USD is the second currency. In a dual currency investment, either the first or the second currency of a currency pair quote can be the investment currency, the currency in which the initial deposit is made. If the first currency, for example GBP, is the investment currency, the second currency, that is the USD, is the alternate currency. If the second currency, which is USD in our quote, is the investment currency, the first currency will be the alternate currency. A general rule for DCIs on the reference or the maturity date is that if the alternate currency does not weaken beyond the strike price, the payment will be made in the investment or the placement or the original currency. And if the alternate currency weakens beyond the strike price, the issuer will pay in the alternate currency. He is not bound to do so, but he will do so because it makes financial sense. If the first currency GBP is the investment currency, the relevant strike price, for example 1.55, will be set above the spot, which we saw was 1.50 in our example. The maturity payment will be made in the second, that is the USD, the second currency, which is the alternate currency, if the second currency weakens above 1.55, the conversion rate. That is, the USD weakens beyond 1.55, then the issuer will make the repayment in US dollars. Let's say if the second currency is the investment currency, for example, in the GBP USD quote, if the USD is the investment currency, the relevant strike price for the conversion, for example 1.45, will be set below the spot 1.50. Payment will be made in the first currency, that is GBP, which is the alternate currency, if the first currency weakens below the strike, that is GBP USD falls below 1.45, that is the GBP weakens below 1.45. This can be summarized as follows. You should look at the currency quote and you should look at what will happen to the currency pair quote if the investment currency strengthens. Will the quote move up or will it move down? If the investment currency strengthens and the quote moves up, the strike rate will be above the spot rate and vice versa. If you remember the DCD example we discussed with USD SGD, the first currency USD was the investment currency and the conversion rate was above the spot price. Let's see what happens if the second currency, the investment currency, as we had discussed in the second example. As you may have guessed, the conversion level will be below the spot price because if the first currency, which is the alternate currency, weakens, the quote will move down. Let's take the example of AUD USD. Investment amount is USD 1 million. This basically means that the second currency in the quote AUD USD is the investment currency and AUD, the first currency in the quote, is the alternate currency. The spot AUD USD at the time of investment, let's say it is 0.75, and the strike rate will be below the spot rate, which is 0.745, because if the investment currency USD weakens, AUD USD will move up, and if the alternate currency strengthens, the AUD USD will move up. The spot AUD USD on settlement date is 0.73, which is below the strike price of 0.745. Let's say that the investor's view was that the AUD, the alternate currency, will strengthen and the investment currency USD will weaken. The investor believed that AUD USD will remain above 0.745 and the settlement will be done in US dollars, which is the investment currency. However, the investor view turns out to be wrong. The AUD weakens to 0.73, which is below the strike price. Therefore, the settlement will be done in AUD. To summarize, if the second currency USD is the investment currency and the relevant strike price will be set below the spot, payment will be made in the first currency AUD, which is the alternate currency, if the first currency weakens below the strike, that is AUD USD is less than 0.745, or the AUD weakens to below 745. Let's take another example, this time with the USD Euro pair. The investment is USD 1 million, which means that USD, the first currency in the quote, is the investment currency, and Euro, which is the second currency in the quote, is the alternate currency. The spot USD Euro at the time of investment is 0.93, and the USD Euro strike price is 0.945. That is, the conversion rate is set above the spot price because if the investment currency USD strengthens, the quote will move up. Spot USD Euro on settlement is 0.94. The investor view was that the Euro, the alternate currency, will strengthen and investment currency USD will weaken. The investor believed that the USD Euro will remain below 0.945 and the settlement will be done in USD, the investment currency. The investor view turns out to be correct. The USD Euro spot on settlement date is below the strike price of 0.945. Let's say it is 0.94. Therefore, the settlement will be done in the US dollars, which is the investment currency. To summarize, if the first currency, for example USD in our quote, is the investment currency, the relevant strike price will be set above the spot. The payment will be made in the second currency, which is the alternate currency, if the second currency weakens above the strike. That is, for example, in our case, USD Euro moves above 0.945 or the Euro weakens to above 0.945. Based on the above examples, let's summarize the key points about DCDs and DCIs. A DCD is a structured product where an investor deposits an amount in one currency called the investment currency, or the placement currency, or the original currency, or the base currency. The DCD involves a currency pair, that is two currencies, and they have a deposit and a currency option. Also, the deposit could be in the form of a long position in a bond or a money market instrument denominated in the investment currency. The issuer promises to pay a specified interest on the deposit. The promised interest rate is usually higher than that of comparable deposits in the market because DCD has an element of significant risk. And now, what is the risk involved? At the time of making the deposit, the investor gives the issuer the right to repay the principal and the interest in another currency called the alternate currency. The rate of conversion between the two currencies is fixed. In effect, the investor is selling a put option on the alternate currency at a specified strike price, which is the conversion rate, to the issuer. And what happens when an investor sells a put? The investor gets a premium in the form of an enhanced yield. Unlike the case when you sell a put option on a stock and get the premium credited immediately to your account, the DCD investor does not get the premium, which is in the form of an extra interest, immediately. The interest obviously is received at the end of the term of the DCD. However, like all option writers, the DCD investor is exposed to significant risk. While we discussed that DCIs or DCDs involve a short put on the alternate currency, it could instead have a short call on the investment or the placement or the original or the base currency. That is, the investor must sell the investment currency to the issuer and receive the alternate currency. The issuer buys the right to buy the investment currency from the investor at the conversion rate and sell the alternate currency to the investor. However, the option buying protects the issuer if the currency pair moves adversely from his perspective. Therefore, the investor is exposed to significant risk. Note that the investor cannot be sure of the currency in which he will get back his investment. The issuer retains the right to decide the currency in which the investment is paid back. He can repay the principal plus the interest in the investment currency or the alternate currency. Obviously, the issuer chooses to repay the principal plus the interest in the currency which is beneficial to him. Remember, he has the right but not the obligation to sell the alternate currency to the investor because he has bought a put option from the investor on the alternate currency at the strike price, which is the conversion price. Therefore, the issuer has the sole discretion to decide the currency of repayment irrespective of the relevant spot rate. However, if the issuer chooses to repay in the alternate currency, the conversion has to be done at the agreed conversion rate. The issuer will do the math on the reference date and decide whatever suits it. Since the issuer buys the right to repay in the alternate currency, the investor should be prepared to receive the currency and convert it into his investment currency, thereby incurring some cost that will reduce or wipe out his yield. Therefore, the higher the probability of conversion, that is the exchange rate moving beyond the relevant conversion level, the higher the interest rate promised on the dual currency deposit. That is, the premium of the option will increase as the risk of the investment increases or the risk of conversion increases. This is obviously true for all options because an increase in the volatility or the risk increases the price of an option if we keep all the other relevant factors the same. Note that DCDs are short-term structured products, for example, with a maturity of 1 month. Since it is a structured product, there are no fixed terms of DCIs or DCDs, although they have similar features. Note that some DCDs may pay the principal in the alternate currency, but pay the interest in the investment currency if the conversion price level is breached. We can have many variations like this. Now the parties to the DCD contract, the issuer and the investor, must agree upon the investment amount subject to the minimum or the maximum amount, if any, set by the bank. They must agree on the currency pair, the interest rate, which is an annualized yield, the maturity period, and of course the strike price or the exchange rate at which the issuer may exercise his right to convert the principal plus the interest in the alternate currency. Note that the investor must hold the product till maturity, else he may incur some penalties or breakage costs, reducing or even eliminating the yield. Considering these features and risks, DCDs are suitable for investors who can bear the risk of receiving and holding the alternate currency. In effect, he should be indifferent, at least to a certain degree, about which currency he receives at maturity. Generally, the DCD is structured in a manner that the investment currency is expected to weaken or depreciate, or at least remain stable against the alternate currency. It should not breach the conversion rate barrier. If this actually happens, the principal plus the interest is repaid in the investment currency. The investor hopes that this will be the case. This is the best case scenario if you presume that the bank makes rational choices. Stay tuned for more on this later. If the investment currency appreciates against the alternate currency, that is, the alternate currency weakens, the principal plus the interest can be returned in the alternate currency, which is the weakening currency, leading to a suboptimal outcome for the investor. As we will discuss in detail, the bank will convert only if the alternate currency weakens beyond the conversion rate. If the currency pair is volatile, a rational investor would therefore avoid the DCI or expect a commensurately higher yield. On the other hand, the issuer hopes that the investment currency will strengthen so that his repayment cost reduces and his net profit increases. How? We will discuss this with examples later. Note that the distance of the strike rate from the spot determines the risk and the expected yield. If the difference is large, that is, the strike rate is far away from the spot, obviously the risk of conversion is lower than if the strike rate is close to the spot. To recap, if on the investment maturity date, the investment currency strengthens so much against the alternate currency that it breaches the strike, the principal and the interest amount will be paid in the alternate currency, the conversion being done at the strike rate. Note that the conversion, if any, is done at the strike rate, not at the spot rate on maturity. The spot rate on maturity is just a reference date. Here we end the first video in the 4-part series on DCDs. You can head over to the next video, which discusses the common scenarios for the issuer and the investor in DCDs. Thanks for watching.